Welcome to Konexio Insights360 by Ambareesh Baliga. Here we discuss sectors and interesting companies. If you like this video, please press the bell icon and subscribe. Ask any fund manager to list the sectors they would look to remain invested in for the next few years. And among the various sectors, you'll surely find railways, defense, aerospace, and semiconductors, possibly in the top quartile. If you find a company which is an ancillary to all these sectors, would it be a great idea to look deeper? Millworks Technologies Limited, which is coming out with a BSE SME IPO, is catering to these very sectors and supplying to OEMs as well as Tier 1 and Tier 2 suppliers in these sectors. The company manufactures high accuracy machine components, sheet metal parts, sub-assemblies, and integrated assemblies under build to print and build to spec engagement models. Now, what is build to print? It means where the customer provides complete design specifications such as CAD files, mechanical drawings, and bill of materials, and the manufacturer builds the product exactly as outlined without altering the design or material specs. Here, the margins are stable and quite decent. Now, build to spec means where the customer broadly defines the product required and the manufacturer is responsible for the actual design, engineering, and validation needed to meet those requirements. The initial process is decently long, could be even a year, but here the margins are superlative. And most importantly, the customer is sticky because they can't go elsewhere for the same product. Also, one important point to note is that they are serving regulated and mission critical sectors. Here, the entry barrier is also quite high, which works as a good moat for this company. For example, they manufacture about 32 parts for BrahMos missile, which will continue as long as BrahMos missiles are manufactured. Currently, about 30% of the top line comes from build to spec, and 70% of the top line comes from build to print. And still, the EBITDA margins are upwards of 36%, with PAT margins around 25%. Now, going forward, the management is projecting about 50-50 for build to print versus build to spec. So one can imagine as to how much higher the margins can climb. A fairly young company, incorporated in 2021, but the underlying business was set up in 2015 by Mr. Sridhar Acharya and Mr. H.K. Madhu. They have 4 manufacturing units in Bengaluru and supply across domestic and international markets with an established export footprint across North America, Europe, Middle East, and South Asia. Current order book size is around 65 crores with a top line of 153 crores. That's as of FY26. Around 70% comes from defense, 24% from railways, but the other segments are ramping up. Debt equity ratio is very low at 0.21x, which will still head lower post the IPO. Return on capital employed is a very impressive 56%. And the objects of this issue is for the capex as well as the working capital requirement. This IPO ticks most of the boxes, so have a look at the investor presentation and RHP. Looks like a great opportunity, but take your call soon as the issue closes on 16th of July. We'll come back to you soon with another interesting idea. Till then, take care and invest safe.